What if you want to start investing, but after paying all the bills, there's only a little money left? What if I told you that just $30 a week could have turned into nearly $500,000 over the past 12 and a half years? The secret? The Magnificent Seven: Apple, Microsoft, Amazon, Nvidia, Google, Meta, and Tesla. These seven giants have been the engine of global stock market growth for more than a decade. But the real question is, can they keep that momentum going? That's exactly what I'm putting to the test. I've started a series where I invest $30 every single week into the Magnificent Seven through an ETF called MAGS, which equally weights all seven stocks. I'm not trying to time the market or take big risks. I'm doing this to demonstrate the power of consistency and compounding, what Einstein famously called the eighth wonder of the world. So let's find out what small money can really become. The Magnificent Seven aren't just popular names, they've been the engine of market performance over the past decade. To put their power into perspective, I ran a backtest. Starting in January 2013, I simulated investing just $30 a week, split evenly across the seven stocks in QQQ and SPY. That's about $20,000 contributed over 12 years and 8 months. Here's what happened. In the S&P 500, that money grew to more than $80,000. In QQQ, it climbed to nearly $120,000. But in an equal-weighted Magnificent Seven portfolio, it exploded to nearly $500,000. Now let's have a look at the annualized returns. SPY is nearly 15%, not bad. QQQ's nearly 20% is stellar. But the return of MAGS is astronomical. That's a 45% annualized return, more than double Q and more than triple the S&P 500. Absolutely incredible. Do I believe the Magnificent Seven will continue to deliver strong returns? Yes, though probably not as spectacular as the 45% we saw in the backtest. With massive investments in AI, cloud computing, e-commerce, and digital platforms, they're positioned for a promising future. In fact, their latest earnings calls confirm that their commitment to AI infrastructure spending will continue well into 2025 and 2026. And here's the caveat. This is only a backtest. Back in 2013, companies like Nvidia, Amazon, Meta, and Tesla were much smaller, and it wasn't obvious they would become the global giants they are today. The results look incredible, but they also come with hindsight bias. It's also important to remember this strategy is risky. The Magnificent Seven are highly concentrated and volatile, with drawdowns of more than 60% in 2022. Nothing here is financial advice. This is simply one part of my own portfolio. Now, let's have a look at my performance. Over the past 22 weeks, I've invested a total of $660, and my portfolio's market value now sits at $722.98. That means I'm up $62.98, or a 9.54% return. Am I happy with that? Definitely, yes. But to give a more accurate picture, I also measure my performance using XIRR, which accounts for when each contribution was made, not just the total amount invested. Based on that, my annualized return is an impressive 51%, even higher than the back-tested scenario. That shows the power of steady investing and catching strong momentum early. I'm an avid DCA investor. I believe that by consistently investing in high-quality ETFs, anyone can build massive wealth over time. Behind this magic lies the future value of an ordinary annuity formula, the cornerstone of the dollar-cost averaging strategy. In this formula, C represents the cash flow per period, I is the rate of return, and N is the number of investments. Let's take a simple example. If you invest $10,000 at the beginning of each year, earn 10% annually, and do this for 10 years, by the end of the 10th year, your investment would grow to about $175,312. In my case, I invest weekly, so both the cash flow and rate of return are adjusted from annual to weekly. That means my weekly rate of return is roughly 0.8%, and my weekly contribution is just $30. If this pace continues over the next 10 years, my investment could grow to nearly $230,000. And if the same rate holds for 15 years, it could exceed $1.8 million. That's the true power of consistency and compounding. I'll keep sharing my progress regularly to inspire anyone who wants to build wealth slowly, steadily, and with discipline. The portfolio's value may rise sharply or drop suddenly, and that's perfectly fine. I'm not here to time the market. I'm here to give it time. Only time will tell the result. And if you think the MAGS ETF is a bit too volatile, there are two other great alternatives to consider: the revised QQQ 3-fund portfolio and XLG, which focuses on the largest U.S. companies. You can check out the videos for more details. Thanks for watching.